Good day, everyone. Today is February the 2nd, 2024. You can tell it is February the 2nd, 2024 by my quote board. Take a look over at the SOFR quote board. We've come off a little bit, but I mean the whites at one point, I think, in SOFR, the whites were down something like 26 ticks. Just boom. We just had the NFP jobs report that was just blowout hot. I mean, hotter than Hades and Jerusalem in July. Just hot number. U6 is sticking steady at 7.5%. I think U3 dropped down to around, I want to say 3.7, if my memory is serving me correctly. But just a hot number. So yes, you can definitely tell it is February the 2nd, 2024. Regardless, the concept of bubbles and asset bubbles has been on my mind as of late. And I'm just going to say, first of all, I think that word is thrown around way too much. Bubbles, right? Oh, it's in a bubble. You'll hear that thrown around a lot. And a lot of times, what I see is a lot of newer retail guys, self-directed retail traders or aspiring traders will get involved in a trade, a short, and it moves against them in basically a major sector. And they get stopped out, and it's an emotion reaction, right? Oh, that's because that's in a bubble. That market's a bubble. They'll try and, especially when they try to take a short position 2 or 3 times. Oh, that's in a bubble. I think that word's thrown around way too much. You have to properly define what a bubble actually is. Like how do you define a bubble? Okay, so it's funny, I was just looking at this, I was thinking about bubbles, and it's funny, I was looking at this chart, right? This is the SPX 2005. I can still remember, believe it or not, 2005, I can still remember this. A short position I tried to put on right here against the market. I had some longer term stuff that I was holding, and I didn't like the market, so I put on a short, and it didn't work out, right? Obviously, you can tell it didn't work out. But I was holding all my longs, and then I decided to put on a short position, and it didn't work out. Incidentally, you're looking at the time period where I really got involved in learning about how to hedge effectively. And because it's like, oh, wait a minute, it didn't hurt that bad. I wonder why my short didn't hurt my entire portfolio that bad. That got me involved in the subject of hedging, but that's a different subject, right? But a lot of people think about this time period from 2003 to 2007, and they think of asset bubbles, right? Well, the bubble actually wasn't in equities. Eventually, a bubble can become a systemic problem throughout the financial system, and as we all know, it will affect equities greatly, but it wasn't as much in equities, from like 2003 to 2006. That's really that's not the bubble that caused the problem. If we want to talk about the bubble that caused the problem, we know where to go for equities, right? So there's where we go, like 1991. Actually, this is not the best index to look at if we want to talk about what was the asset bubble that caused the problem in equities. There we go. There's the asset bubble that caused the equities. Let's pull up the NASDAQ 100, right? So you have to specify where exactly is the bubble, first of all. But yes, that was an actual asset bubble in equities, right? But that sort of outlines for folks who are new, you got to start properly defining bubbles. First of all, where do you see the bubble, right? Like in 2003 to 2006, it wasn't as much in equities. It was somewhere else, and then it spread to equities, in a I always screw this word up, I swear. Systemic problem. I always want to confuse systemic and systematic. So, yes, in a systemic problem, it spread throughout the financial system. So where is the actual asset bubble, right? Well, back in the 90s, very obviously the asset bubble was in tech. And so that's first of all. You got to properly define what a bubble is, where it is. Is it a bubble? How do you know it's a bubble? You might be wrong even with your definition. You might be early, like with other trades. But that's sort of been on my mind lately. Like, when can you start to think you're in a bubble? And then the next very obvious question is, how do you trade a bubble? Now, there's an initial answer, and I think it's wrong. right? A lot of guys will tell you, well, you just buy. You just hold on and buy. All right. There is a program and a model I know I have. Oh, how do I explain the nuances here? I'm going to get a bit into sort of lifting the hood up, of sort of our approach to things here. And I'm going to do that this month because this is a subject I want to explore this month. There is an approach where you can buy and be okay generally if the bubble explodes for an extended period of time. Okay? There is an approach for that. However, I think if you're a newer trader, an aspiring trader, I think that answer can be dangerous. You can get yourself in trouble with that answer. Because unless you have a quantified way to approach a bubble by, going along and buying it, and you would know how to do that in an acceptable, quantifiable way, I think that can be very dangerous. And the reason why it can be dangerous is because what happens is you get pulled into cognitive biases. Okay, there's a phenomenon known as house money, and you get pulled into that. And you think that when you have house money, there's a phenomenon of when it turns against you and what happens to your psychology, right? Because you're just thinking, well, I'm just buying and it's working. Okay. The problem being is when it stops working, and it'll come back. And we've all seen those charts of what happens with trader euphoria and the cycles and all of that. But that's a very real, well-studied cognitive bias and problem that human beings have when an asset bubble actually does blow up, right? And you hold on, you come up with reasons, your rationales. See, this is what folks that don't know how to approach it in a quantifiable way will do. They start, I think I know what to do. Oh, what I'll start doing, and what they're doing is they're style drifting without realizing that they're style drifting. And then the whole thing blows up, and they've averaged down. They think it's worked, and then it'll go on a little farther, and oh crap, do I have enough money to average down because I went all sorts of problems can start. So we say that to say that the whole concept of just buy it. First of all, you're running into a cognitive bias when the bubble ends if you don't have a quantified way to approach trading when you think you're in a bubble. We have some quantified ways to identify bubbles. We like them. It doesn't necessarily mean you're going to be in a bubble because markets are always changing, always adapting. So first of all, I'm going to review here. You have to identify, are you actually in a bubble? Okay, then B, how do you trade it? And you have to have a quantified way to trade it because the other problem besides the cognitive bias is, and this is something that experienced traders know, is that everybody thinks they're going to be the first one for the exit door as everybody rushes to the exit door. And the problem is there's only one exit door. Right? Everybody thinks they're going to be the first guy out and they're going to properly identify it. There's cognitive biases there. There's real liquidity problems there. And everybody backs up from the table. Let's get out the door real quick. Well, there's only one door. So how do you approach trading a bubble if you think you're in a bubble that you have properly identified? Well, that's something we would like to discuss this month in February and actually moving forward in the coming weeks. How do you trade a bubble? Now, in doing that, we're going to start talking about some things that we're popping the hood, as it were, right? We're pulling our collector's cars up and we're popping the hood and we're showing you some things under the hood. Now, to do that, I think we need some recompense. So now we're getting into the concept of some premium content. So we've already set that up because I've talked to the other guys at GTC Traders, the other partners, and quite frankly, we don't want to take our time up with whenever you set something up like this up, you want whoever is looking under the hood and paying for premium content, you want it to be a seamless process, right? And I am running sort of a single family office structure. And quite frankly, I don't have a lot of time, right? But you want whoever's doing this taken well care of. And, it's got to just run smoothly. So we thought, okay, well, how are we going to approach that? All right. What we've set up, and we'll see how it goes, is GTC Traders. We set this up at Patreon, and what it does, it's got 2 membership tiers. It's like a read the positioning and read the report. Very, very fair pricing, we think. Sort of getting into either our positioning and our thoughts on positioning. So things like, and a multitude of things, right? Like, so if you're looking at equity income or even income, building some sort of fixed income account, what are our thoughts? That's read the positioning, right? Higher vol, long index strategies, what is our stance regarding those strategies? That's something we talked about this month. Is the actual base program says to do XYZ, and we're not doing that this month. And it said to do it. It said to be long the index, and so we're getting into the nuts and bolts, right? But so what I'm trying to describe is the process. First of all, is in read the positioning. What you're going to see is, like, for example, we have a long index program, right? And we say it said to be long in December. It said to be long in January. It also says to be long the index. Ones could do that if they want to, sort of be balls to the walls. Our approach says, yes, the program is saying be long the indices. The program is also saying to set that aside for now. And that's something I'm going to talk about a little bit more this month. Okay? But we don't get into the reason and the rationale behind read the positioning. It's a look over our shoulder, right? Everything that we're going to do is just like look over our shoulder and what we're thinking. It's by no means the only way. And it does that for everything. So not just long index, short index, but like some of the newer guys I know call it dividend investing. I prefer more of a professional term of just, building a sort of like some sort of fixed income account that's, the whole thing when you sign those broker agreements, right? When you sign those broker agreements, they ask you what's your objective. Is it growth? Is it capital preservation? Is it income? That's one of the objectives, right? So some guys have the newer guys call it, I guess, dividend investing. I prefer, like I said, the professional term, building an account for fixed income for yourself. We talk about that. We talk about precious metals, a lot of things, right? And it's more just the position. Here's our position. Even portfolio approaches, this is what we're doing. Valuations, right? So valuations, what are we doing? That's just read the positioning. Read the report gets into the quantifiable metrics that we use. In other words, okay, how do I say this? As I've said, I'm the senior partner in a private proprietary firm, right? And all of us that are in these firms have signed, quite frankly, NDAs and non-competes. So in other words, don't disclose the proprietary models, and you can't go to somewhere else and compete. So non-competes and NDAs. So in tier 2, if it's a program, because I've got many programs. I've almost forgotten how many programs I've designed and seen by others that others have done. That's a whole topic in and of itself. If it's not covered by an NDA and if it's not covered by a non-compete, then we're going to talk about it and read the report. So it's like, yeah, you know how we said that? And by the way, everything you get in tier 1, you get in tier 2. But basically, it's like, yeah, you know how we said that? These are all the quantifiable reasons why. This is the approach. And if it's not covered by an NDA or non-compete, then we're going to talk about it, right? And I do believe compensation is necessary. That's just, it's funny. You see that all the time. And I get it because of Furus, right? I think it's something Jesus said one time. You'll know, how did he put it? You will know the tree by the fruit it bears. In other words, a rotten tree will produce rotten fruit. Good tree will produce, fine fruit. So in other words, you get to know somebody and you can sort of tell, right? You can sort of sniff them out. And plus, just, is there any positive expectancy? That's why at GTC Traders, we are actually producing like a VAMI grid, right? Like the sample portfolio, we're showing you, okay, yeah, okay, great. All these guys too, God, they don't even realize what they're doing. It's like, I made X dollars per day. What does X dollars per day mean? That doesn't mean anything. Nobody in the professional world talks about X dollars per day. We speak in terms of percentages. Furu types, they don't even realize what they're doing when they're doing that. They're realizing that they're exposing that they don't know what they're talking about. Nobody in the professional world talks about dollars because it doesn't mean anything. Regardless. Right? Yeah, we need recompense. Sorry, there's a Bible proverb I think about all the time. The workman is worthy of his wages, right? If we're going to set aside time and we're going to talk about programs that we've developed that are not under an NDA, then quite frankly, we deserve some recompense for that. And quite frankly, and I said this in the one video entry that we have on social media gurus, what's nice lately is more guys like myself and other guys with verifiable track records, as well as, verifiable resumes. Some of them, it's like you can verify, yeah, this guy worked at Goldman. This is, X, and it's not just in finance, it's everywhere. This is a special ops guy. This guy over here, he's a Harvard professor. I'm sorry, or was a Harvard professor. Sorry, workman's worthy of his wages, right? Due recompense. I don't believe in slavery, all right? I don't work for free. Consulting fees about $350 an hour. So I'm just going to tell you, like, consulting with me is about $350 an hour. So that being said, I think this is more than fair. It's a recompense for our time. And that's what we're going to do as we lift up the hood. Because this month I'm going to talk about how do you identify a bubble, how do you trade a bubble, and not get caught in that trap. And there's always a give and take. It's not like, haha, this is how you take advantage of every aspect of the bubble, and you'll always make as much money in the bubble, and then you sidestep it. No, everything's a give and a take. We're going to talk about that in Read the Report this month, and we've set that up. And we like this because we don't have to worry about the processing and the setting up. It's just wham, bam, there you go, right? It's just there, right? We don't have to deal with it. Partners don't have to deal with it. We don't have to spend our time on it, and people are well taken care of. You can find the link over here anywhere on GTC Traders. Well, that's interesting. It should be on the homepage too. Interesting. Well, it's over here. If you go to articles, it's over there. It should be on each page, but you get the link there. It's a Patreon site that we've set up. The only reason we chose that is because it makes the processing easier for us. All right, so that's what we're going to be talking about, and some of the stuff I'm going to be putting up there for free, but it's that whole question: how do you trade a bubble without getting caught in the cognitive biases, the style drifting that can take place, and everybody rushing for the exit door at the same time. We've got some approaches. We're going to share them this month, and so that's just been what it is. That's our thoughts, right? And our thoughts. I really like that we picked this name, GTC, like the order type, right? It's good until it's canceled. The same thing with our thoughts, because markets are always in flux. If you want to be a really good trader, the skill you need to do is be able to identify, well, crap, I was wrong. And just adjust and not have an emotional tirade about it. Just adjust. I was wrong. Period. Have the humility to accept you're wrong and adjust, because markets are always in flux. So our thoughts are like that. Our thoughts are good. We think they're good. Until they're canceled. They're GTC. And that has been what it's always been. It's simply been our thoughts, not yours, for whatever that date is. As always, stay safe, trade well, and remember that love doesn't cost a dime.